Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
Welcome back for another episode of Opto Sessions with me, Hayden Brain. Today I'm talking to Paul Markham, the lead manager on over $4 billion worth of assets as one of Newton Investment Management's most experienced global equity managers. Newton is one of 8 investment firms under the Bank of New York Mellon umbrella, cumulatively the 7th largest asset manager in the world with $2 trillion assets under management. We discuss the industries most affected by the pandemic and which will have to fundamentally alter their business models here on in, what Trump or Biden will mean for US stock markets, and where Paul and his team are looking for outperformance this year and beyond. Paul gives us true, unadulterated insight into how an industry heavyweight identifies opportunities and manages billions of dollars on a daily basis. If you trade or invest in equities, this isn't one you want to miss. Hello and welcome, Paul. Great to have you on the podcast. How have you fared working from home? Has it been a big shift from your normal day-to-day?
Yes, I think when we first started it felt like it was going to be quite difficult to concentrate. And I've always found that when you have the odd day, for whatever reason, when you do work from home, that sometimes it's hard to settle and it's hard to sort of communicate in the same way with colleagues as you do when you're in the office. But I think the kind of necessity of this and the fact that everybody was in the same boat made it a lot easier. And I think everybody's adjusted to it far better than they thought. So overall, I would say that I've taken to it pretty well, Hayden.
Yeah, great. Yeah, I definitely get that point. And luckily, actually, we're just going back into the office, starting 1 day a week next week, which I think will really help. I don't know whether have Newton got any similar plans.
No, the first possible day back is the 1st of September. But I think that the honest truth is that the authorities, the Mayor of London, the government, etc., will probably look at the relative success that a lot of companies have had with their IT systems holding up, and a lot of people finding that they've made good use of the extra commuting time. And they'll realise that the necessity of returning to a physical place of work, where it's not entirely, in certain cases, much more important than it is for people like us who work in an office environment. So my suspicion would be that gets pushed out, or if it does come back, it will be for selective staff or in a part-time capacity. So as yet, no confirmation of that, but I would be quite surprised if I were back in the office in any meaningful way before the end of the year.
Yeah, that makes complete sense. And actually, that leads us quite nicely onto our first topic and just sort of how businesses have been coping with the impact of social distancing measures. It seems that it's sort of fundamentally changing businesses' models. I actually watched a recent interview that you did with CNBC where you used the tourism industry as an example. So there, if we do start there, are we seeing fundamental changes to the way in which these firms are doing business?
Yes, we are. And I think that the important dynamics here relate to how far back to what we describe as being normal we're able to get. And we'll come back to that. It will be a recurrent theme through our conversation, I think, Hayden. But we must remember the age and attitudes of the population. And something that's really important to remember is that our population is aging. It's not to the same extent in every country, but most developed economies have an aging population. And of course, those people are all of the age of majority, and so they vote. And we're in democratic electoral cycles. So governments will be very wary of wanting to do anything which will annoy those people or alienate them in any way. And if you think about the way that they would spend their money as well, are you, as an elderly person who may in the past have gone on a cruise or gone on a long holiday somewhere, or been a frequent visitor to other places, comfortable going in public places or getting into small environments such as aeroplanes or trains with other people? And I think that those things are big questions when it comes to spending. And it's certainly going to be something which afflicts all of the travel and leisure industries. And also, of course, one thing which I think people are not thinking so much about necessarily, is that as those modes of transport and leisure activities become less patronised, they will, of course, become more expensive, because not only will the demand for them to some extent be affected, but also the fact that the yield per square foot that they're able to achieve, be that in a restaurant, be that in a theatre or a cinema or on an aeroplane, will be lower. So although, of course, in economics, things do tend to naturally balance themselves out. So, for example, oil prices are likely to stay muted as a result. It won't completely make up that shortfall. So I think that a combination of fear, the change in price dynamics, and businesses also, of course, becoming potentially permanently impaired or extinct as a result of this are very real, and they will be impactful, I think, going forward.
Yeah, interesting. And then, so from an investment perspective, I suppose, with kind of your equity manager hat on, like getting subsequent yield from those assets could become quite painful as a result. Like, what's your outlook on that?
Well, I think that certainly there's two ways of looking at that, really. One is the sort of the literal sort of ability to make money from an asset as a yield rather than what you receive as a shareholder, which is a slightly different thing, as you know. But the basic ability to squeeze all of the income you can out of an asset, in many cases, is going to be very challenged. And you just talked about the return to work and office space and so on. That's going to be a really challenged environment, and certain business districts around the world could become very difficult places to own real estate. And that will be something which will be a big change in dynamic, I think. And we've already seen a big shift here in the UK with demand for viewings or virtual viewings, and even in some cases offers being made already on houses in the sort of outer suburbs of the big cities. So, people presuming that they won't have to go back on a permanent basis and wanting to live with more space, a bigger garden, maybe a home office, that kind of thing. When it comes to actual yields, as regards the yields on securities and on equities in particular, they're challenged as well, because we've got big sectors such as the banks having been told by their regulator that they must crimp or suspend the dividends which they're paying, and that's going to have big ramifications for the kind of sectors which perform in the market. And of course, if that carries on for a long period of time, the investment cases in some of those areas can become pretty tough for many investors to understand. So on many levels, I think yield of assets is going to be a big question over the next couple of years.
Yeah, that definitely makes sense. I imagine that's worked pretty well to whet the appetite of some of our listeners, and we'll return to some of those topics shortly. But if I could just circle back, I was interested to sort of find out more about your background. And firstly, I wondered where your interest in finance comes from. Has it always been a passion of yours?
It hasn't. And I hope that isn't too disappointing an answer for you, but it did certainly grow. When I was a student, both at school and then on to university, I was actually a modern languages graduate. So I studied French and Hispanic studies, which is, broadly speaking, Spanish and Portuguese, and culture and literature attached to those languages. And my first job as a grad was at Visa International, which is, has been very successful in recent years as a listed equity. In fact, it wasn't listed when I was there, but a company which was really at that time a not-for-profit organisation funded by the banks who were members of the Visa programs. And so it was effectively a kind of central clearinghouse and marketing organisation for retail banks around the world. And I went there as a grad, and my role was as a relationship manager with French-speaking banks in Africa, which was sounds a little bit exotic, really, repeating it now. And in fact, I kind of really enjoyed it there. I realised after a couple of years that the wider career prospects around that industry seemed at that point to be quite limited. And I took the difficult decision to leave. And I came to Newton as actually a commercial representative for a short period of time for Spanish-speaking clients primarily. And it was really then that I managed to spend some time with the investment team in terms of meetings with clients and some trips and so on. And I just thought this was mega interesting. I thought this was just fantastic. And I just thought the extent of my interest would be rewarded with being able to listen and talk to these guys. And in fact, an opportunity arose then to be a trainee on the global equity team, and I took that with both hands. And that was nearly 20 years ago, and I haven't looked back, really.
Yeah, wow. So you've been with Newton IM for some time then. I mean, like you've probably got a relatively unique perspective in terms of, or on how the company's changed since you first joined. Like, can you give us any insight into how a big corporate company like Newton Investment has changed since the time that you joined? Yeah,
I mean, the most obvious change really has been, it was still a relatively small company with relatively small but growing assets under management when I joined in 1998. But the big change really was being acquired by a much larger entity, which was BNY Mellon, a large systemically important and listed US bank. Importantly, over much of that period, Newton has been very much in charge of its own cultural destiny. It's had a fair degree of autonomy, and quite a few colleagues from those early days are still with us at Newton. And so it's quite interesting that I was at a team meeting just yesterday with 3 colleagues, all of whom have been at the company for at least 20 years as well in each case. So we had, I think, nearly 90 years of Newton experience in the room. So, that was pretty cool. And so, it's certainly not just the company, however, which has changed. And certainly the industry has really moved forward a long distance. And the global financial crisis was a big part of that. And it's always worth remembering that the crisis was really caused by a very small number of people who were quite rightly identified as being irresponsible in some of their behaviour, and excesses in the system got to be rather extreme. But in fact, the investment industry got tarred with the same brush to some extent as the banks, which was rather a pity. So regulation has really swung in the opposite direction. We have a lot of regulatory training, for example, and online training is very frequent in that regard. And I did an online training course this morning, for example. But also, even things like liquidity in markets has become a little bit more challenging, because the sell side, the brokers are not allowed to hold as much inventory, as they call it. They're not allowed to have a book of available stock for you to use as liquidity, and that can sometimes make trading when you transact on the funds a little bit more challenging. So, it's still a fascinating industry. It's still a privilege to be asked to manage other people's money, but the surrounding controls and rules and regulations have certainly moved on since those early days.
Yeah, interesting. And then, so if we come to present day, I read online, and you can correct me if the figure's wrong, but you're the lead manager on over $4 billion worth of assets. Can you give our listeners any insight as to the psychology required to manage such a large amount of capital?
Yeah, I mean, one thing that I learned from a very early stage, and my first boss taught me, and I've always stuck by it, and it served me pretty well, is I just never think of anything on the funds as an absolute number. I always think of anything which is either the weight or percentage of the fund which is in a certain stock or sector or geography, or an outflow or an inflow, as a percentage. And obviously there are moments when the sheer size of a fund can overwhelm if you're trying to transact, and if it's a very large fund, that can move prices and so on, and one has to be a little bit careful with that, with the help of our dealing room, of course. But nonetheless, it makes it much less daunting, particularly when you're starting out, to think of everything in terms of percentages. And I don't really think any differently from a £10 million fund to a £1 billion fund, and I do manage both sizes. So I think in that regard, it's always worth trying to distance yourself a little bit from the size of the money, but with the realisation that someone's grandmother's £7,000 worth of ISA is just as important as a pension fund's £700 million worth of assets as well.
Yeah, completely. Yeah, that's a really interesting way to look at it, actually. And so to kind of go on from that then, are there any common traits among successful fund managers in your kind of equity or global equity space that you've identified, you've been able to sort of pick out over the 20, 30 years or so you've been in the business?
Well, there is more than one way to skin a cat, I would say, and that's not a get out. I mean, that's just the truth of it, and that can apply in all sorts of ways. That can apply to time frame from an investment perspective. It can apply to style. It can apply to approach as regards the kind of companies that you like to buy. But I think broadly speaking, a couple of things which I would say I think are quite important. One of them is to be patient, but also with the ability to change one's mind. And those things aren't always compatible for obvious reasons. But I think the ability to realise that one is wrong and to exit a position and go to another part of the market or another stock where you can, make a better return, I think is a real difficult thing to do for a lot of people in the market. They like to at least get their money back, where in fact you could sit there and have the stock halve on you again if it's already underperformed. So I think that that's important. I think the wider picture is really important, and Newton is good for this. We have a thematic backdrop. We have a sort of number of sort of prevailing long-term themes that we see as being very informative to economies and markets, over a 5-year plus time scale. And I think that the ability to look holistically at bonds, equities and currencies, even if you're only managing one of those three, I think is really important. And also, finally, I would say the ability to understand when a management team really wants to push a business forward and has proper achievable ambitions for a company, instead of a management team which sees being management as being the ultimate goal. I think, the kind of CEO that sort of sees his time as chief executive as being the reward for a long career and the time to sort of harvest all the rewards of that, I think is the wrong kind of management. You need to have people who understand that there are all sorts of stakeholders, including equity holders, who will want to see capital reinvested effectively, or if not, returned in the form of dividends. And that's a really important thing to know. I think in terms of personality traits, I think certainly intellectual curiosity is of course paramount, perspective as we've mentioned, but also the flexibility of thought in a world which undergoes constant change, and we're seeing that again. And sometimes when new technologies or new types of business come through, the initial reaction that one may have, having been in the market for a long time, is that it's hard to get your head around it. But you better do that, because otherwise you'll get left behind.
Yeah, completely. And I mean, that's actually been really fascinating. And I want to dig deeper on some of those strategy points a little bit later on in the episode. But I said at the top of the interview, we'd return to current markets. And I want to go back to those industries most affected by the coronavirus pandemic. First of all, I think our listeners would be interested to know that aside from tourism, is there another industry that particularly stands out in terms of one that's been affected by this virus?
Yeah, Hayden, there are negative and positive impacts, and there are some common threads through these sectors which are most likely to be long-term impaired, if you like, by this whole event. Certainly, they're tangential to tourism, but nonetheless, they're important to mention. So, leisure, the idea that social distancing could, in some form or another, be permanent would be very damaging to theatres, to cinemas, to sports centres, all sorts of facilities which really do, going back to one of our initial points, have to derive a certain yield per square foot. They're not built to be able to operate as a business with everybody being a certain distance apart. Restaurants and pubs are very obvious in that regard as well. And even though some of them already have been pretty resourceful in being able to adjust their business models to deliver goods, for example, the question mark remains whether or not the current premises in which they sit are appropriate, both in terms of their location, but in terms of the way that they're built, the shape they're in, and the number of people they have working in them. And that's all really important to remember. Aviation, we mentioned already, is very similar as well. And of course, real estate is likely to be a big issue, and we talked about that at the beginning. And certainly, there are a couple of conflicting points here, really. One of them is the fact that the longer we go through this whole episode, in a situation where a growing number of people, especially those in the younger end of the age spectrum, will become increasingly nervous about spending time close to other individuals, and they won't want to touch, lift buttons, it's very simple things that we all take for granted. But on the other side of it, of course, we have a whole social fabric. Our towns, our cities, our villages are all built for a world where people aren't afraid of being in close proximity to other people. Think about the 300-year-old pub in the countryside where people like to go on a cozy cold night with a roaring fire and have a pint. Those guys aren't going to be able to operate anymore. Now, it's true to say that very few of them are listed, but they may be listed from an architectural perspective, if not a stock market one. But you get my point that business models can be essentially broken by this, and I think that's going to be really an important point when it comes to the political side of it, because governments just won't have the wherewithal, nor the time, the political capital, nor the economic conditions to be able to effectively reconstruct public spaces, buildings, and so on. It's just not going to be possible in the confines of where we sit right now. So all of those things mean that some kind of return to normality is extremely desirable. Clearly, that's stating the obvious, but it's really important to remember that. But at the same time, if we go to this kind of halfway house where there is a constant impact from it, but within the confines of our previous economic structure, it may well be that we have some kind of a permanent impairment, which will take many, many years to play itself out.
Yeah, and essentially, do we see ourselves in that halfway house until a vaccine is properly created and dished out to the globe, essentially? I mean, or can we move past this? Can we move out of this halfway house until that vaccine exists?
I don't think we can, to be honest, unless there is some very, very significant economic proof from various sources and without reasonable doubt that there is some kind of T-cell or essential human biological immunity created. So far, the evidence on that has been mixed. And so I think that that's unlikely, Hayden, I would say. What I would also say, however, is that, again, it's not just a question of a vaccine for this particular disease. What about if there's a COVID-20? Will we have all this all over again? It's an attitude changer. And I think that that's certainly something which is going to be quite informative over the way that society lives for some decades. And so, I think it's certainly a good question from the point of view of our current cycle and this current situation. But I think the attitudinal impacts that it has could be quite profound. Yeah.
Well, I completely agree with that. And in terms of gauging where equity markets in general are now, and when a return to relative normality is complete, originally many hoped we'd see relative similarities in corporate earnings year over year by Q4 2020, by the end of this year. But that time frame seems to have shifted now. Is that fair, in your opinion?
Yeah, absolutely. It won't be clear until well into 2021 as to what the trajectory of economic growth in markets are. And there's a really important aspect to this, actually, which is that if we start seeing a faster than expected recovery in earnings, and that will have to be really demonstrated on a longer term basis rather than being some kind of sort of snapback, which is what we initially saw clearly a month or two ago with lockdowns being lifted, then that could certainly encourage markets to push on further. But until we get into a situation where we can say there's some kind of adjustments that can be made that would give us an apples for apples comparison, I don't think you can really say that markets will trade on anything other than central bank and government stimulus and news flow. And outside those things, the market doesn't have a whole lot to hang its hat on. And in terms of that earnings picture, I think you'd have to be talking about second half of 2021. And even then, I think that's subject to change.
Yeah, definitely. And as an aside then, it was just interesting to me that it could be argued that corporate earnings were already looking pretty sluggish throughout 2019. What's your take on that?
Yeah, I agree. And in fact, I think it's almost too much for the market to think about at this stage. But if you take a step back and look at where we were in January, and it was really, I think, at the end of December when the first sort of publicity around COVID-19 started to emerge, but the market wasn't taking too much notice at that stage. And what it was most concerned about was that we'd had a return of around about 30% last year, as near as damn it to 30% on the S&P, without any earnings growth, which is a huge, what is known as a re-rating, which is when the market goes up without any underlying earnings rising, which effectively means that the multiples of earnings that the market is willing to pay rise. And that's what happened last year. And it usually happens on the basis that there's going to be some form of earnings coming through in the year or two after that, which can then justify those higher multiples. And so we'd already seen markets run ahead of economies, and there wasn't really that much evidence in earnings in 2019 that suggested that they were about to undergo a cyclical upturn. So I think that's a very good point. And in fact, even if we were able, through some very, very significant developments, to even regain the trajectory of earnings that we were at before COVID-19, we would still be left with a market which would be looking a little bit rich, ceteris paribus, and would also require some form of further economic improvement in order to justify those valuations.
Yeah, so then kind of moving away from earnings, I suppose, and focusing on just the valuations of equities themselves, we've I mean, despite all this negative economic data, we've seen equity markets hit all-time highs over the past few months. I've heard several theories about this trend, but what's your take on that divergence?
Well, I mean, there's a couple of really big themes. I certainly would say that, central bank and government stimulus are really, really important. For the point of view of what's known as the discount rate, which is the interest rate level that you can put into your equity models in order to derive a valuation. Central banks have been very quick to get that down as low as they can, and the Fed has made the most progress in that because it had the most rates to cut. Rates were very, very low elsewhere already. Certainly that is supportive. A big difference from what we saw in the GFC 10 or 12 years ago is that this time around we're also seeing fiscal stimulus. And this is really quite different to the great financial crisis because effectively, loosening the tax coffers and the abandonment really of austerity is a very big political decision, but also more importantly, I think for markets, it is usually seen when used in conjunction with aggressive monetary easing as potentially being reflationary. And there is a real reason for there to be some form of desire for inflation to return. And that is because governments have now landed themselves with a very, very significant stock of debt. And they will really want to get inflation moving. Firstly, because it tends to, for a period of time, flatten the feeling of economic growth, even though it's sometimes when it gets out of control, that can become pretty illusionary. But also, it will mean that the stock of debt as a percentage of GDP will be falling. And that's a policy which was pursued by Western governments in the aftermath of the Second World War, and something which is likely to return again. And of course, equities for a period of time, and as long as it's not very significant inflation or hyperinflation, can act as much better inflation hedges than bonds can, because of course the income of an equity is variable where the income of a bond is fixed. And so from that point of view, I think that this is a very significant reason why equity markets have continued to ignore some of the economic news. But of course, that doesn't mean that this is the end of it. It doesn't mean that we're just going to sail on merrily from here, I would say.
Yeah, so with that in mind then, to what extent are equity markets being propped up by a sense of, well, first hope that the worst is behind us, but as well due to that parallel monetary and fiscal stimulus that you've discussed there?
Yeah, I mean, I think there is a sense of, certainly I think in March there was an opportunity, having seen a very significant drawdown of equity markets, to buy, and the market took full advantage of that relatively quickly. And then we got back to the stage after, some big stimulus programs where briefly the S&P got back to being flat year to date, which was a remarkable result, really. But since then, it's kind of trodden water, and markets, I think, have sort of retreated a little bit into thinking a little bit more cautiously around where the future sits. But I think that the attractions of equities, as much as anything, are dependent upon the fortunes of other asset classes. Certainly, fixed income asset classes are quite challenged because their yields have come down to, in some cases, historic lows, which means that their valuations are very rich. There's not much yield available if you buy a bond. Although some of the yield-like equities have become a little bit more challenged because of dividends being cut, the fact is the overall return you can derive from an equity, particularly if it's an equity with growth-like characteristics, may be higher than a bond over a 3 or 5 year period at this stage. So I think that probably will support them to some extent. But I think as you say, the hope that there will be either an unexpectedly good outcome as regards a vaccine, or the idea that from here the economy can only get better, which is, I would suggest, probably a little bit soon and maybe mistaken, will to some extent see equities catch a bid.
Yeah, interesting. And a facet of that recent rally, or at least since mid-March lows, has been tech stock and tech sector outperformance. So they've been at the vanguard of that rally since mid-March lows. Could that performance, in your opinion, be tiring somewhat?
There's a really, really big question, I think, on these, Hayden, and it's really important, I think, as an overall determinant of equity markets from here. And it's like a fork in the road, really. And that's whether or not we're inflationary or not. And I think that if markets do perceive that there is some inflation coming down the line, and I'm not talking about in the next few weeks or the next few months, because that's a time when inflation will be extraordinarily muted for very obvious reasons. We have rising unemployment, we have falling consumption. Those things are all disinflationary. But certainly from the point of view of a medium to long-term outlook and the chance that this very big base of money, this very loose fiscal policy will become inflationary, that's likely to lead to underperformance of technology, really because they're companies which have been very richly valued in some cases, predicated upon the fact that they have a visible and secular source of ongoing growth. So it's hard to imagine, if you look at some of the big tech companies, that they're not going to be bigger in 5 years' time than they are now. So that's what's really led markets to be quite supportive of them. However, they have benefited, given their business models and given the dynamics that they have in terms of pricing and growth, they have benefited from lower interest rates. Now, if you think that there is some kind of reflationary environment, that's usually associated with stocks which are more cyclical as being the beneficiaries. So that would relate to more industrial style stocks in an older economy sense. The financials, for example, which always tend to benefit very much from inflation because they start to get pricing and they start to get what's known as spread, the difference between purchasing and selling of securities, for example, or interest rates on accounts and mortgages. So those things would benefit. And if that's the case, they have to be funded from somewhere. And of course, the simplest thing to do is to fund any purchases in those areas from the stocks which have done very well, which would broadly be, the technology side of things, as well as some other areas such as healthcare, for example. So, yeah, I think it really depends on what you see about that. I think, if you are not concerned, however, about trading equities on a 10-year view, and if you're not concerned about the fluctuations of economies and so on, it would feel that the chances of the tech sector outperforming over a long period of time is probably quite high, would be my view. But I think if you've got maybe a 3-year view, then you may see that slightly differently.
Yeah, because I've heard, again, probably on the shorter time frame, people refer to this rotation in sectors as the great rotation, i.e. this, we've been a long-term trend of tech outperformance, and now we're finally shifting into the more cyclical sectors, like you mentioned there, like financials and things like that. But is that purely determined, I suppose, by your time frame then? If you are on a 3 or 2 year even time frame, that might be relevant, but over a 10-year time frame or longer, tech is the place to be.
I think so. I think if you just use a simple example of, say, somebody who's, coming through maybe university right now or in the early stages of their career and have a very different outlook as regards to the kind of goods and services that they wish to access and the way that they want to work and the kind of goods that they want to buy. Someone of my generation, Hayden, I mean, you're going to laugh, I still buy CDs and DVDs, right? I'm sure you haven't bought a CD probably in your life. You probably only ever streamed music or used iTunes, right? Even iTunes is an outdated kind of, concept now to some extent for younger generations. And I think that, so if you extrapolate that to how the consumer pans out, and probably just as importantly post-COVID, how businesses operate, I think you'd have to say that is more supportive for the ongoing spread of technological solutions. It's hard to realize right now that actually, until the end of 2019, the UK was the biggest exposed country in the world to e-commerce, and it was just under 20% of overall retail sales. Now that's gone up to about a third with COVID-19, but it still is lower than perhaps you may have expected. So there feels like there's kind of a long way for that to go. But if you were to cut that down and segment that into age groups, there'll be very significant differences between the over 65s and the under 30s, for example. So, I think that if you think about that as being a kind of germination of new behaviours going forward, then I think certainly the 3-year to the 10-year timescale could show very significant differences.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show. I want to move us on to your strategy, or the global equity team strategy at least. I wanted to get some more detail on that, like I signposted earlier in the interview. So in terms of how the team sort of identifies opportunities, selects equities, and how you manage your respective portfolios, do you use any top-level, longer-term themes to govern your equity selection?
We do. We have some broad themes, which are generally political, social and economic in nature, and they're the changes that we see as happening in the world, which are observable but we think could run for a period of time. It really will inform a lot of the decisions around the ambit of companies, if you like, which will very much impact the way they plan and do their business. And we also have a set of sub-themes under each of those 9 themes, which give a bit more, if you like, granularity and colour around the specific ways in which those themes will impact the companies. So they really are the starting point for us as regards, if you like, where we do our research and where we want to favour capital allocation within the portfolio.
Yeah, and one of those sub-themes might have been NetFX. It sort of piqued my interest when I was doing a bit of research before the call. How does NetFX, for example, help shape the global equity strategy? Well,
NetFX is named very specifically to really have 2 pillars to it, broadly speaking. One of them is the fact that the enablement of business models which would be unthinkable in the past via online and the internet is very important. But also there is a net effect, which is that actually the bricks and mortar tradition which we have for many businesses, particularly consumer related businesses, is going to be significantly challenged. And there was a period of time where you could say that actually the only unequivocal winner from online had been the consumer, because it had some very significant benefits around pricing, because of course pricing transparency grew very significantly with online, but also of course more recently we've seen things such as the ability to be at home and receive all of your goods via delivery. That's been very advantageous in the times when there's a disease out there, or the other sort of benefits of that. And of course, from the point of view of availability of products, you can actually see when you order something online whether or not it's in stock. And you can't have that when you go into a shop. So all of those kind of things have come together now, but have become much more embraced by companies. So NetFX really allows us then to say, well, okay, which business models can deal with this, which can't, and which ones maybe are the opportunity where maybe they're early on in this journey, but we can capture that and hope that it will be very accretive to their sales and earnings going forward.
Yeah, interesting. So as a result of that, I suppose, you then narrow down your focus to, I read 50 to 80 securities. I wondered firstly how that compares to competitor strategies in this space.
There's quite a broad range of strategies within global equities, and they go from very, very aggressive portfolios with maybe even 15 to 20 stocks right up to index strategies. But to give you a bit of a flavour, Hayden, for the opportunity set, our benchmark is the All Countries World Index, and that has 2,800 stocks on it. So, if we're owning 50 to 80, you can see we're doing quite a lot, one way or another, of sieving down and funneling ideas down. So we're not the most aggressive out there, but I would say 50 to 80, when we could invest in any equity market in the world, is pretty focused. It does, however, still allow us to achieve a sense of diversification, both in terms of currency, geography, sector, and underlying business. Currently, the portfolio has 55 names, but we still, have a good degree of spread as regards, we have investments clearly in the US, Europe, Asia, Japan, etc. All sorts of, most of the main sectors are represented in the portfolio. Now, we don't mind not owning a geography if it's, we clearly wouldn't have a zero weighting in the US, for example, but we're happy not to own a relatively small market at all. We're happy not to own anything in any sector where we don't like it, but we do try to achieve some kind of balance in the portfolio.
Yeah, and then as I understand it, stock selection is driven by bottom-up proprietary research. Firstly, can you talk to us about what that research process looks like for someone that's sort of never been involved in that process, and for our listeners that are completely external to a process like that?
Yeah, we have a team of global industrial analysts. We have 16 of those, all based in London, who have a fully global remit around the sector that they analyse. So, for example, a banks analyst, a pharmaceuticals analyst, an industrials analyst, etc. And they will do cross-company research and valuations to compare whether or not one company is better than another. We would expect them at the early stages to assimilate the themes that you mentioned just now into their analysis, and then to pick the stocks that they think have the best chance of making money for the portfolios. And that the way you make money in equities is either by something which is growing its earnings and therefore the price stays constant in lockstep with that rise in earnings, or has what we call a re-rating, which is when the value of the stock relative to its earnings actually rises. In a perfect world, you'd have both of those things, but that's not always the case. But that's what they're trying to identify. But then when it comes to our team and our portfolio construction, we apply then the considerations that we have, what we're looking for as regards the stocks in the portfolio, what the underlying client wants us to achieve as regards performance objective and volatility. And of course, we have to manage that in the context of a finite amount of cash, and we don't have the ability to just put as many stocks as we like in the portfolio. So it really is a three-stage process: the thematic backdrop, then the analysts who come to us with their ideas, and then finally we decide which of those ideas we invest. And to give you an idea, there are 3 times as many stocks recommended to us internally as we hold in the portfolio. So there is a good degree of discernment, I would like to say, still going on at the portfolio management level.
Yeah, definitely. Yeah, that's really interesting. And I guess one area that we haven't discussed thus far is ESG. I read that the strategy incorporates environmental, social, and governance analysis within the process. So I was interested to know how you screen for ESG compliant securities. Which factors and metrics are you looking for in that process?
Yeah, I mean, we've had a long and proud history in ESG, and we've been very much, certainly on the governance side, very active ever since the formation of Newton over 40 years ago. And for many years, we were the only major UK house voting consistently on remuneration, for example, for UK companies, where it wasn't really the done thing. And in recent years, of course, the S and G, the E and the S have become much more important as we've seen considerations around global warming, greenhouse gases, carbon emissions really come front of mind. And that will only continue to go in one direction, I would say, Hayden, because, of course, a younger generation of people have been brought up much more aware of these issues. And certainly, it's become evident to us that there are certain sectors where the marginal buyer, the new person coming to the stock, is harder to come by because they just don't want to own certain sectors. And, of course, ones which tend to spring to mind would be tobacco and energy, where there are very significant pushbacks from many investors when it comes to ESG. So we have a fully resourced ESG team who does a separate analysis on each of our stock recommendations. I'm glad to say that this portfolio actually is in the top 30% of portfolios in its sector for these considerations. But this sector also includes what are known as sustainable funds, which actually have a separate mandate of taking these into a higher level of consideration. So given that this isn't the nature of our mandate, the fact that we're in the top third, I think really reflects very well on us in our process.
Yeah, that's fascinating. It's almost testament to the fact that it really is inbuilt within the Newton sort of psychology and way of doing things, given that wasn't your mandate at all. That really is fascinating. And I guess I'll move us on to our penultimate section of the interview then, and I wanted to talk about sort of potential opportunities in the equity markets. We've touched on a few, but just given the headwinds and macroeconomic obstacles we've discussed in the podcast thus far, where are you looking for outperformance in particular at the moment?
Well, we've been quite keen to balance the portfolio out because we don't have any greater visibility than the market does on where we go from here. And I think anybody that is positioning their portfolio very aggressively in that regard is to some extent, taking a little bit of a risk with, whether or not we go into this much better recovery scenario with inflation, or whether we do have a very suppressed economy with a lack of inflation. And if we get the former, it is going to be those kind of value sectors, and the valuations there are very low. So we have increased our weightings in certain sectors such as auto parts and financials. Not significantly. We're not, significantly overweight in auto parts, and we're actually still underweight to the financials. But we have closed some of those gaps a bit to make sure that the portfolio can really, be much more of an all-weather kind of portfolio. But we haven't, as yet, significantly cut our exposure to those secular growth stocks, which have served us so well for so long, and they're the well-known US tech names, for example. But also, we've been a big fan of stocks with exposure to music streaming, and there's been a couple of new listings in that space which have kind of shone a light on the valuations available. So I think that's one thing that I would certainly point to. There are some secular growth stories where maybe there haven't been enough listed stocks to really sort of attract the market's attention. And we think that there are a couple of names within the market which have very significant music businesses which can benefit. Not necessarily the ones which are just listed in that space, but ones which are part of a bigger company. And then we've also got the US election coming up. And that could certainly be an opportunity for some areas. Certainly the market will start to get worried as we come into November around particularly the healthcare space and the defence sector in case there is a Democratic win. I think that this particular election at this stage looks like a relatively comfortable situation for the Democrats, but it will narrow. And there is evidence that 41 to 42% of the electorate is currently pretty firm on voting for the Republicans. And of course, what will happen as the whole electoral campaign goes on is that a couple of things will come very sharply into focus around the personalities. Of course, Trump is divisive in many ways. Will be seen as being a challenge for him to get re-elected, given that some of the people that gave him a chance in 2016 may not have been too impressed with some of his more recent behaviour around COVID-19. But on the other side, you also have question marks over the physical and mental frailty of Joe Biden. And it may well be that if he gets involved in those kind of presidential debates, that he may not come out of those as well, particularly if Trump finds a way of being able to show those frailties up without necessarily being seen as being a bully, which is a bit of a balancing act for him to achieve. So it's probably going to be quite close. And the market will be watching very closely as we get into that period. And of course, let's not forget that if we have a very significant bounce on a month-on-month basis in the economy as a result of there being some kind of positive news around COVID-19, the Republicans and Trump certainly will try to claim that as being all of their doing. And that will be, if we have a very fast recovery in place by November, then we may well see the Republicans do better. So I think that's another thing to watch out for in markets. And certainly if you're of the view, if you really feel very strongly that the Republicans can win, and you're looking for opportunities in markets, you may well decide that coming into October and November, do you want to get involved in the healthcare and defence areas, because they are the ones that will be seen as being the most negatively impacted if there's a Democratic win.
Yeah. I mean, that makes complete sense. And sticking with the US then, I mean, US equities have long outperformed European equity markets. And I wanted to dig into sort of regional differences and your views on those. I mean, are you more or less bullish on European equity markets now that it does seem European nations have dealt perhaps more effectively with the pandemic than the US?
I think that there's an indirect impact of that, Hayden. I think that the thing to remember about European markets is they have a much higher preponderance of what you may call value style sectors, old economy sectors. And there's a lot more industrials, there's a lot more financials, and much less technology related stocks, fewer technology related stocks in the European markets than there are in the US. So if that kind of rotation that we mentioned came to pass, then European markets would probably benefit. They have higher dividend yields, more exposure to cyclicality. The problem for Europe has been that it's not really an economic self-starter. So a lot of the biggest companies in Europe have tended to make a living through exporting quite a lot. Some of the best consumer companies in the world, some of the best healthcare companies in the world are listed in Europe, but they don't necessarily have Europe as their biggest market. So they're going to be things which are going to be very dependent upon whether or not the market rotates. Secondly, of course, European politics continue to rumble on. We've seen kind of agreement just as we speak now today on the European Recovery Fund, which was subject to a significant amount of haggling over the weekend and the last few days. And then there's Brexit as well coming up in December at the end of this year, which will continue to sort of weigh on markets to some extent. So while I think that there is some chance, especially if there's an inflationary rotation, that European equities can trade at higher multiples relative to the US, it does seem unlikely that they'll be able to permanently or even temporarily close out the valuation differential.
Yeah, interesting. So to frame a similar question, I suppose, in a slightly different way, I want to dig into sort of developed versus emerging markets. I mean, since the US stock markets hit lows mid to late March, like we discussed, emerging markets have picked up momentum, actually retracing oversold conditions and rising to new highs. Are you bullish on emerging markets at all?
I think it's certainly depending on which ones, really. I think, and it's certainly quite a standard assumption that they all kind of trade together in one amorphous kind of lump. But in fact, there's quite a difference in some ways between the Chinese equity market, which is now, quite dominant, and some of the others. Certainly in terms of that potential reflationary environment that we may see, that would particularly benefit the commodity-related emerging markets. And let's not forget that, some of those big emerging areas such as Brazil, Indonesia, South Africa are still very much commodity-related. And to some extent, they will be looking to benefit from any ongoing opportunities in China where they can export. Of course, the other side of that are countries like India, Turkey and South Korea, which are to some extent the opposite. They will prefer lower commodity prices because they don't have any of their own. And so, you can sort of look at it that way. But broadly speaking, I think when it comes to emerging markets gaining favour from investors, it would generally be that kind of risk-tolerant, weaker dollar, higher inflation environment. So what you could say, if you wanted to sort of be relatively brief about it, is that the emerging markets may end up behaving in the same direction as Europe, but in a more pronounced manner.
Yeah, that's really interesting. And that might be a good point to leave us, or to leave the main body of the interview. And I want to move us on to our quickfire question round. So this is something we do with all of our guests, and it's simply a light-hearted way to end the episode. And you're perfectly welcome to answer the questions in as little as one sentence or even one word. Question 1. What, in your opinion, is the top mistake investors make?
Taking profits too soon.
Yeah, that's one that's definitely come up before. Question 2 then, where do you go for investment or economic insights? Are there any specific publishers you read, for example?
Mixture of internal research. So Brendan Mellon, who I know has been on this show, who's a very useful source of information, and also some long-standing market contacts.
Great. So question 3, what is the most memorable moment from your career today?
It was winning my first segregated mandate, which was with a very well-known and prominent UK regulator, with a very prestigious and, in some cases, famous members of their board. And that was back in 2006.
Great. So question 4 then, and the penultimate question of this round, a top tip for your younger self?
Be more constructive about your own strengths and don't get too hung up on your own weaknesses.
Yeah, solid advice. Question 5 then, final question. What gets you mentally ready as part of your morning routine?
Well, I don't want to be surprised by comments on the names that I own in Asia and Japan overnight. So I really want to make sure that I'm on top on any big moves on those before I get to our morning meeting so I don't get a nasty shot.
Yeah, that makes complete sense. Well, Paul, you've already been really generous with your time, so I'll leave it there. But thank you very much for coming on the podcast.
Thank you, Hayden. Thanks very much.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.